Steve, you seem all ready.
Yep, I'm good to go.
Wonderful. So
Put up my screen.
Yes, please do. So next up is Steve Monaghan, who's got a very interesting career in innovation overall. So he spent time with Dell and Compaq in product management there before then dipping deep into financial services. Has spent time with Shinsei Bank here in Japan, with DBS Bank in Singapore, and then AIA in Hong Kong. Before, like about a year ago, started off his own venture, Gen.Life. So it will be interesting to hear about this journey and also how it's going about and thinking about disrupting insurance with artificial intelligence and zero operations approach. So all over to you, Steve.
Okay, great. If you could just confirm I'm clear and you can see the screen.
All clear.
All clear. Great. Okay, well, today I thought rather than ducking too much into Gen.Life, I'd just give you kind of the thinking behind it and talk about what's happening in the areas of artificial intelligence and all that sort of thing. So I'll duck straight into that, if that's okay. The world around us is changing, and it's changing very rapidly. And it's very hard when you're standing still to really understand and imagine the future. So I just want to share a short video, and please jump in and tell me if the video doesn't play on stream. But it's a really good way of thinking about how that future is changing. So I really love that that's a Nokia phone. And what you find inside major corporations, I was Chief Innovation Officer at DBS and then same thing at AIA. You kind of have the same thing. When you start talking about what's happening in the world of technology outside, it's very impossible to conceive. It's like the example from Singularity University, 30 exponential steps. Most people gravitate to that 30 meters and they think that it's incremental, whereas in fact, it's a billion meters and 26 times around the planet. So it's very difficult for people to understand what level of change is going on in markets around them, which is why companies are dying so quickly today. And indeed, at the, as everyone's talking about it now, but at the World Economic Forum, they're talking about the fourth industrial revolution and what's really happening in markets around the world. And I find that within financial institutions, we're not really prepared for such a dramatic shift. We're still looking at that incremental 30 steps and 30 meters versus what's really happening, in that billion meter dash. So, we've gone from an age where the big eat the small, and we're fast moving towards an age, then we moved to an age where it was the fast eating the slow. And really, we're in the age of platforms now. And we're starting to see platforms and technologies really hyperscaling at rates that we never imagined before. And one of the first things, that's really important for most corporations to do is to start shifting their horizons. When I was Chief Innovation Officer at DBS, when I arrived, we just had these competition boards, if you like to think of it that way, where we'd look and benchmark ourselves against our industry competitors. But in reality, the lines between industries have already blurred. I mean, in fact, they really don't exist. And we set our sights back on your Googles, your Amazons, and Microsofts, and Starbucks, etc. And when you change that shift and focus, your expectations around what you achieve and the experience that you deliver changes quite rapidly. And what we've seen is these platform plays are increasingly eating the world bite by bite. Many years ago, Bill Clinton was famous for saying it's the economy, stupid. And then someone stupid got into the White House and called that fake news. But the reality is, the real news is that it's really around technology now, and the focus has fundamentally shifted. If we have a look, drives economies today, it's clearly, very clearly technology. And that technology is becoming pervasive in ways that most corporations aren't ready for. When we think about it in terms of how the world is changing, we're starting to understand almost everything about us is data, and our ability to make sense of that data is also changing exponentially. And it's changing at what I'd call hyperscale, at a speed and pervasiveness that is very hard to imagine. So you had Masayoshi Son-san in Japan from SoftBank say that basically artificial intelligence should have an IQ of around 10,000 in 30 years. Now that's 10,000 times greater than myself and about 100 times greater than most people. So that's a really significant shift. And the way that we interact and process, and based also on the last presentation, the way that we support those through financial services is going to change quite dramatically. In the insurance industry, for the best way to think about the insurance industry is it's like inviting a bunch of people to blindfolded dance on a table. We analyze risk by working out who's likely to fall off. And when they walk up to the edge of that table and fall off, we kind of go, oops, and we pay out for it. And that assumes that you've really got no insight into risk or ability to assess or prevent that from happening. And that's not a very intelligent way to manage risk in the connected world. Now we don't have that situation existing. It's like moving from the Stone Age and pretending that what's going on around us in IoT, etc., isn't really happening. And that's just not true. In a connected world, those sensors are not only moving outside, but they're moving inside. Things like genomics in insurance and in medical are fundamentally changing treatments and the risks themselves and the economics of those risks. And in the insurance industry, we're an industry that's focused on loss, which relies on someone falling off the table, versus an industry that's focused on prevention and life. And I think that shift is quite profound and really starts to challenge the very fundamentals of how you manage and mitigate risk. Most organizations are very heavily stuck in the mud, as you can imagine. Legacy systems, you try and build these high velocity data systems outside and then plug them into batch run systems. It simply doesn't work. So there's a real imperative to shift, because the world is changing, and it's changing at a hugely dramatic pace. And our relationship with technology is changing quite significantly. I think there was in the news this week, and believe it or not, 30% of millennials felt that they would be comfortable with relationships with robotics. That would be impossible for an older generation person to even understand, that you could have technologies that's starting to get emotion and starting to interact in ways that you never thought possible in the past. The reality is that we are data. Everything we do is data oriented. We leave data trails everywhere we go, and our ability to consume and manage that data is growing at a rate that's incredible. In fact, if you used to think that we're flesh and blood, we know that we're really 3.2 billion base pairs of code. And that code, we can now amend a single element and change the way that we act. So we're already curing hereditary diseases by using CRISPR to start amending our genome. And I think that this is a fairly fundamental development when we take this step to understand now that we are actually bits of code. If we look at behavior, we know behavior is changing. It's changing around mobile. It's about to change around voice. It's changing in our interactions, not only socially, but also at the corporate level, and in the way that customers engage with corporations. If you were to use an Israeli voice detection tool, you could analyze my voice today and you could tell whether I'm manic, depressive, schizophrenic, diabetic, or have a heart condition. So almost everything we do when regulators talk about privacy, they're talking about the rearwards looking view that assumes that it's hard to access that data and that asymmetry is possible. If we look forward, that asymmetry in information is really not possible. If we look at risk, we know that our risks are changing and they're changing quite dramatically, as are our abilities to offset those risks. Perhaps in banking, we understand this better than insurance. If we have a specific risk, we can either mitigate it or we can hedge it. Insurance doesn't operate that way today. So in many ways, our world is turning upside down, both from a consumer perspective and from a corporate perspective. We've heard about the shift to the empowerment of the consumer. It's time for corporations to really start shifting to truly understand the magnitude of that change. What's driving this, and we hear a lot about Moore's Law, but I'd like to raise two other very important laws, Moore's Law, Metcalfe's Law, and Kreider's Law, and they are equally important in understanding what's driving tech. Each of these are exponential technologies. So Moore's Law is that processing power doubles every 18 months for the same cost. Metcalfe's Law is basically the law of work. It says the value of a network grows at the square of the participants. Kreider's law is the law of storage, which is basically that storage doubles every 18 months for the same cost. Each of these are three exponential curves. If we think of them a different way, think of them as processing networks or IoT or new data sources and existing data that are knowledge base. If we look at it in that context, that leads us to different thinking. And in the human context, we think of that as assimilation, learning, and knowledge. And for me, artificial intelligence sits at the middle. And that's important because it's the sum of three exponential curves, not one. So when we think about the rate that we learn today, it's growing at an exponential rate. Our knowledge and our ability to store that knowledge is growing at an exponential rate. And our ability to actually assimilate and make sense of it is growing at an exponential rate. And with quantum, that may take a giant leap forward, to quote Mao. To really understand the speed and scale that this is occurring, here's a simple look at the number of cameras in the world. And you can see that it's your classic exponential curve and it looks nice and neat. And that's the way that we can look at it and fit it on a screen and comprehend it as human beings. But to really appreciate it, we have to put it to its real scale. And if we do that, we can see that it's growing at a rate that's impossible for human beings to articulate or understand. And actually, that's only the vector of the number of sensors. And we could apply this to almost every area of IoT is growing at this rate and collecting data. But if you take the data element, the quality of that data collection is actually increasing at the same time. So from 1976, the first digital camera was 0.1 megapixel. If we apply that today, you would have to actually increase that access about 100 times to actually understand how quickly this data assimilation is growing. Now, very clearly, our rates of learning are more attuned to the left side of the graph than the right, and hence the rise of artificial intelligence and why machine vision is playing such an important part in that role today. And for me, I always refer to this as hyperscale because it's just not a scale that we're used to dealing with. When we look at that progress, here are two short videos that give you that perception of how quickly it's changing. This is 2 years ago, 2015. So you kind of get the idea, right? And 2 years before, those things weren't wireless because the battery requirements weren't good enough to keep them operating. But if you fast forward just 2 years from that DARPA challenge in 2015 and have a look at one many of you familiar with, This is how far it's come in just 2 years. Now, many years ago, I was an athlete, and I was definitely better than the 2015 version, but I can't possibly compete with the 2017 version. So my redundancy in that field has completely gone away inside 2 years. So my ability to function, if I was competing in that area, is gone and history. And we're seeing this in many areas of artificial intelligence now, as artificial intelligence continues to become more pervasive. The rate of improvement in this area is hard for us to fathom until we actually see it, as we just did. And what it means in terms of financial services industries is quite interesting. What drives both banking and insurance is really two core things: risk and transaction cost. And today we focus on the left top part of that quadrant, where we get the best people to access create the best solutions, to access the richest customers, to drive the best margins. So we automatically have an incredibly high cost base, which means we only address a small part of that long tail or that total market. In reality, with artificial intelligence, with digitization, with human-centered design, etc., we have a completely new ability to rethink markets. It used to be in Porter's 5 forces that we could either be differentiated or cheap. So you buy the Mercedes or you get a cheap alternative that's a cost leader. So you're a price leader or a cost leader in a market. And in Dell Computer Corporation, where I worked a long time ago, we developed very much a focus on becoming the cost leader in a market, and then manage communications to improve our ability to be differentiated. In digital today, and the way we interact, and that's going to a next level with artificial intelligence, we can both be the quality leader in a market and the cost leader with digital. And I think that this is a fundamental shift that most corporations have completely missed. So their strategies are either driven by one or the other, but they don't realize you can have them both today. And what's important, that as you scale down to the bottom half of that graph and you start reaching mass markets, as mobile phones have done, as computing in general has done, that's really what drives behavioral change. Behavioral change isn't going to occur in the top left quadrant. It really occurs when you start getting massive market penetration. So your ability now to use different channels to communicate in very sophisticated ways is now really accessible, and the cost of that technology is dropping rapidly. The impact of that from a social perspective is quite significant. So you have Carney, who's the governor of the Bank of England, put a forecast that this will mean the loss of about 15 million jobs in the next 10 years in the UK. That translates across to 80 million jobs in the US and about 250 million jobs in China. And what this means at a company or a financial institution level is that really what's different this time is it's not just the call center folks that are going away or the low paid income. These are some of our brightest people are going away. And so if you know there's going to be massive job displacement, and many banks are now already a little further ahead than insurance and massively starting to lay off and substitute with technology, unless you have plans for what you do with those folks, they're never going to help you get to where you want to go. And in fact, that number has expanded quite significantly. Radialio came out and said that 40% of all jobs would go, and McKinsey, pushed that number up to 800 million jobs just a couple of weeks ago. So if we have a look at how technology is displacing and changing the landscape of insurance, it's pretty interesting. If you take the simple example, about 40% of worldwide premiums are in car insurance. So along comes Google, a search engine, and Uber, an app. And when you bring these two types of technologies together, you get something interesting. So from the human perspective today, you have about an accident rate of about 1 in 1,000. If you have the assumption that if you start automating driverless cars, so I could arrive at work and send my car out if I own the asset, out to work to get a return, and then I'll call it when I need it. Utility of that car goes up from about 3 to 4% per day up to 70 or 80%. So there's a natural linear reduction in the number of vehicles that you're going to actually need to fulfill that mission if you can get that type of return on asset. And that's pretty interesting because there's a linear correlation to insurance, right, as to what you'd have to insure. But that's not the end of the story because of data. And what's interesting, and I presented this to the board of a leading German car manufacturer, and they seem somewhat unaware of all of these implications. The investment in sensors actually, at a minimum, reflect what's already happened in aviation. If we crashed 1 in 1,000 flights, having done that in the last 2 years, it's unlikely you'd hop on the next airplane. But in fact, we've dropped in aviation, the accident rate to about 1 in 4 million, which means that effectively that insurance market and 40% of one of the biggest industries in the world just completely disappears. And the question is, what do you replace it with? What is the new risk? And the new risk isn't around car insurance. It's really around cyber risk and network risk. So that industry is going to transform into something completely different. And I've never heard anyone talking about it. So, and I don't know of an insurance company with the competency in cyber risk today. So it's quite interesting to look at how we shift with technology, but how we fail to recognize how that impacts our business models. And of course, we know that this implies that millions of jobs will be lost in cab drivers. And I love this example because this is a Hong Kong taxi. And the Hong Kong government, when Tesla introduced their cars here, and I drive a Tesla, they wouldn't allow the calendar app to be included in the car. And if you have a look at this Hong Kong taxi, I could spot that there are at least 5 calendar apps that are traveling in this car that the driver's being able to assess. So, our ability from a regulatory standpoint to actually comprehend this change is not there either. And I think that this leads us to some new opportunities. But if we try and put this in the context of time, in the 1990s, Detroit used to produce about $215 billion for the US economy. If you fast forward to 2014, Silicon Valley, the top companies in Silicon Valley, produced the same, but with 1/10 as many people. So you got your 10x, and it takes about 10 to 15 years because it takes that time for penetration to go to drive behavioral change. When we fast forward that and look at the implications of AI, it's likely that it'll be another 10x, and if not 100x change over the next 15 years. And I think that that's a really interesting way to start thinking about implications and mapping whether you're actually making enough progress to be competitive. As I said earlier, Ray Dalio came out and said that 40% of all jobs will go. And again, that's gone up. But the other side, and we from technology, and I used to develop pricing models and stuff and run product businesses. I ran Dell and Compact's consumer product businesses and actually Dell's corporate business for Asia Pacific. If we look at cost reduction curves, it's interesting. A few years ago, I ran a health tech accelerator in AIA, and we had 2 Google DeepMind folks come in, and it took them 2 weeks to outperform radiologists in image assessment. But it was still really expensive, right? So now, second opinion has moved from half an hour of a radiologist's time, or 20 minutes of radiologist's time, down to costing $1. And radiology as a career doesn't really exist anymore. People are actively leaving university colleges because your ability to spot something in an image just has no relevance whatsoever because machines are outperforming us in machine vision now by a significant margin. So those economics, those fundamental economics and cost drivers and risk drivers change. If we look at it from the sequencing of a genome, to understand the magnitude of that change, it cost $100 million in 2001 to sequence a genome. By the current year, it's going to drop to sub $500 US, and by mid 2020s, it's forecast to get down to 3 cents, which is less than the cost of flushing a toilet. Which is why great companies like Toto are looking at building diagnostics into their toilets now. If we look at genomics, what it does for risk, and the same holds true in finance in the way that we measure risk through sensors. Our ability now is to reduce pooled risk to specific risk. And if you know what that risk is, then you can take action to mitigate it. And what's interesting, and for those that are unfamiliar with insurance, is this has 2 really interesting impacts, and it impacts insurance even more than banking. because one interesting thing about insurance is interests align once you're a customer, versus in banking, we always try to make more and more. Firstly, if I can stop you getting sick, it's a great thing in insurance because economically, it means it costs me less in claims. And what's interesting about new sensors coming in market, and this is an interesting company called Cicadia, statistically 1 in 8 women worldwide will end up with breast cancer. And what Cicadia does is it has sensors that are inserts into a bra that are actually more sensitive and more accurate than mammograms, and a thousandth, if not a millionth, the cost. So what's interesting about this is that early detection shifts the mortality rate, which is basically how many people die, from 74% down to 2%. And the other interesting thing is if you catch that tumor at the right time that it becomes cancerous, the cost of treatment actually drops by 1/3 and has an opportunity to be dropped by another 1/3. So you could get down 5/6 of the claims cost. So the economics of insurance are very, very different when you start measuring specific risk. Today you're pooled. So everyone pays for breast cancer insurance, but only 1 in 8 will get it. So, and if you don't know what your specific risk is, then you can't do anything to address it. So what's interesting is now the race is on in both the diagnostic industries, the treatment industries. Everyone's starting to use technology to start working and solving these problems across a vast array of diseases. And in fact, in genomics, 66% of cancers are genomically predetermined. So our ability to take action is changing, which means the model changes from one where you just guess what risk is and pay for it when it goes wrong, to being able to mitigate that risk and stop things happening. When it comes to corporate attitudes, and I've seen this inside major institutions when I'm pitching new projects, what they don't understand, they either criticize or say no to. This is action, because we don't want to say we don't know. The head of the American Medical Association called many of these things pure snake oil. With just a view that it was important to have a human in the loop. This just a year later, 1 year later, a doctor got a new gadget, and he was a surgeon, not just any doctor, but a surgeon inside a well-known hospital. And he tested an iPhone gadget and ended up diagnosing his own cancer. And what this means that as that technology, we know iPhones and the underlying technology will continue to get better, faster, cheaper, well, except for Apple, who keep pushing up the price of the iPhone. But the underlying technology or the performance for the technology is increasing exponentially, and many of the functions that go into your ever-increasing cost of an iPhone is actually displacing other things that you'd buy. So your net value equation is changing dramatically. So what you see on the left in terms of that sensor might likely end up inside the phone at some point. And what's interesting about that is that consumers will start having increasing access and increasing asymmetry of knowledge about what's wrong with them. So if you're looking at managing risk, to ignore the information that's becoming pervasive in markets really is very ignorant. So what you're seeing is dramatic changes in quality, access, and cost. And in fact, we're starting to see things in the medical world that are really moving the impossible to possible. And again, if you have a look at this, there was a robotic brain surgery, a 2-hour brain surgery that was done in 2.5 minutes. And what do we know about robots? They can see better than we can, that their hands or their forceps are steadier than the doctors, because it's humans. It's very hard for us to be perfectly still or to draw even in a straight line. Robots can do this perfectly, of course. And what do we know about these robots? Is every year they'll be better, faster, and cheaper. We've seen our first robotic dentist doing implants in China. And again, this will be better, faster, cheaper. So those assets will really be expensive at the beginning, and they'll become better and faster, cheaper, and they'll improve in quality and they'll improve in function, as we've seen in computing. And this is the economic rationale of why this happens. You know, we have a look at a Chinese factory now. Those robotics are now becoming accessible to even low-tier factories. A Chinese factory replaced 90% of human workers. Production goes up 250%, defects drop by 80. Who doesn't want that to happen with surgery? Who doesn't want that to happen within financial services that's running a business? If you're running a P&L, this is a dream result. So how do we start thinking about how we use it rather than resist it? So that leads us to a real economic imperative, which is better, faster, and cheaper. Always, and the most usual resistance that you'll hear is that, you know, we're a regulated and protected industry. And I promise you, when you go to pharmaceuticals, they'll tell you the same thing. In technology, I've been an advisor to Intel and of course run tech product groups, etc. You have exactly the same thing. So, you know, if you get down to hospitalization, they'll tell you they're incredibly highly regulated and protected, and that is true. But what's changing is quite interesting. If you have a look at NHS, put DeepMind into NHS, in July this year, on July 3rd, it was determined that that was illegal. And yet, just a few months later, 3 months later in 7 days, they're talking about opening that up even wider. And why? Because the economic imperative. NHS, like most health systems in markets around Asia, you know, Japan, China, Hong Kong, Singapore, are on the verge of bankruptcy or will drive economic bankruptcy if they continue on their current trajectories. So it's an inevitable conclusion that these changes will happen, which leads to a very different discussion from a regulatory standpoint. We're moving to a period from regulatory prohibition to regulatory observation. And the reason and the criteria for that observation is usually inclusion, where you're driving better quality, access, and cost to market. This leads us to new opportunities in terms of being able to have proper discussions with regulators. In my own experience, when I first went to Monetary Authority of Singapore for DBS, their sole answer to everything was no. Until I sat down with the chairman of, and went out to lunch with the chairman of Monetary Authority of Singapore, until we brought in the Agency for Science and Tech Research to start helping them go through learning and venturing, etc. Nothing would really happen. So as that started to accelerate, now if we look at this is just 4 years later, I think it's well known that the Monetary Authority of Singapore is actually trying to drive a lot of this innovation. So that shift can happen, but there's a process. And I think what's really incredibly important today is that we take the view of the regulator that takes, you know, it's like a boxing ring where you take, you know, you basically lay down your arms and then you look at how you engage versus how you fight. And when you have collaborative discussion, I think this leads to new opportunities. In the healthcare industry, to explain that imperative, we all know the tensions between China and Japan over Senkaku. While this is a huge issue, this is not the major issue in the region. This is the fact that we're getting old and that there are some very simple economics that don't add up. There's a massive gap. If we look at the top line, healthcare costs growing at about 7 to 9%, compounded by aging populations. At the bottom line, you have incomes that are flat to negative, and you have diminishing tax bases, both of those compounded by aging population and automation. So that gap is unsustainable, and politicians on the gap is unsustainable, and they're beginning to. And what we really need to work out is how you take action against it. So regardless of whether you're in banking or insurance, very simply, the past doesn't equal the present. And so to run with a business model that's framed for a growth scenario versus one that's framed for a declining scenario, you can't possibly have the same business model. You need a better strategy, and you need to understand technology, and you need to understand how you can drive growth in a declining business, which is exactly what Apple did to survive. So it is possible, but it's not within the purview of the way most people operate, because the way most people operate is lipstick on a pig. I'm adjusting a feature at the edge of my business, and I release this new feature with a new interface and a new app, and so tick in the box, my innovation is done. I think that that's all you're going to get is lipstick on a pig. You really need to take a real deep and fresh view back into technology and back into your business model and really understand what's changing. So while I sit and I talk about technology, I also share one simple video that kind of highlights that we aren't going 100% technology just yet.
Steve, you don't get the sound over video, so might need some voiceover.
So technology isn't the answer for everything, and I think that humans still have a significant role ahead. But we also need to start thinking about intelligence and thinking about how to leverage it within our organizations. And so if you step back and you ask yourself, what does it take to build an intelligent insurer or to build an intelligent bank? At DBS, we did do that. We were the first bank to start looking at putting artificial intelligence into core banking. We did that with IBM, which is not a great tech. Apologies to anyone from IBM on the phone, but they're a great natural language processing engine, but they're rubbish at analytics. But the reality is, if you sit back and you ask the right questions, that leads you down a very different path. Because the reality is, it takes people, technology, and data. You really need to assign your best people, and you need to understand the technology, and you need to understand the knowledge you already have. The valuable asset that we have today in financial services is our experience in risk. Technology companies aren't good at managing risk. So if we're able to actually codify what we do in risk management, this can lead us to some pretty significant and impressive areas. So it's a really critical thing to try and tie together industry technology expertise. What we find in financial services is what's lacking is technology expertise. Now, companies like Goldman are paying top dollar to try and acquire it, but most pay lip service to it. It's like, let's get a new website up, or let's do this. But they don't really understand how that technology works, how cost curves work, what value you're getting for technology, how quickly it commoditizes, all those sorts of things. So we really need to take a fresh approach to how we manage corporations. This gentleman's name is John Seely Brown. He sits on the board of Amazon. He's works with DARPA. Former chief scientist at Park and one of the leading thinkers. He sits on the board of Amazon. He's one of the leading thinkers about technology, and I'm lucky to have him as an advisor. He refers to a hacker and a sniper. Where we're at with technology and intelligence today, it's really a mix of, if you bring together an average chess player and an average hacker, they will outperform the best chess player or the best machine chess player. So that human element still has, and if you think about it, it's Metcalfe's law, you're combining two dissimilar networks and the value of that network grows at the square. It's kind of the same thing today. We still have a significant role, and we're not getting to singularity and to Masayoshi Son-san's forecast around that IQ of 10,000 just yet. So what's really critical, and whether you're in a hospital or whether you're in an insurance company or whether you're in a bank, it's really, how do you structure for this high velocity data? You can't take high velocity at the front end and plug it into a back end that's batch run on sitting in an old COBOL system. Things just simply don't mix. And so what's really important when we start thinking about technology, rather than doing features at the edge, foundations matter. And I think that this is really important when we start thinking about how to implement FinTech and how FinTech works with core institutions. Because there's a very simple truth, and that simple truth is, I'm an ex-pilot, high velocity and mud simply don't mix. If you've got your classic mud infrastructure, it's just not going to work. And the results are quite obvious. So again, you're left with that lipstick on a pig analogy. So I think it's really important as to rethink the fundamentals. You can't apply old fundamentals that you had in that low velocity information age to a high velocity information age. Those fundamentals are very different. And I really think that there's huge value between the analytical and the risk management expertise that sits within financial institutions and the creative capacity of startups. Really left brain, right brain. How do you get that capability, and how do you meld it, and how do you bring it together to make it work? And then how do you learn from what we know in technology oh so well, which is technology is a tool, but you really need to design from the customer back to the technology. And that's true. And having run a bank in Japan and seen, we grew our business, our deposit base 25% in 6 months, and we grew $500 million to the top line, 100 million to the bottom line. 6 months for quite a small bank. But when you take that view, you find that view works in any country, having worked across now probably about 50 countries. Often the resistance is you don't understand, it's different here. The reality is that's not true, because there are some fundamentals around human behavior and the way that we interact that are quite constant. No one wants more work, everyone wants to get more done with less. That holds true for consumers, that holds true for institutions. So when we design technology, we have to design with the customer and the business model in mind, and technology is just a tool set. So when we design from an experience standpoint, I look from Steve Jobs, you've got to keep it easy, right? Easy is experience, simple and easy. People often mistake simple and easy as the same things. Experience creates that emotional engagement, which usually drives decision-making. Simple is cognitive. So it's how quickly can I reach a decision, and then ease is the effort that it takes to act on that decision. Very few things that were done and originated in banks or insurance companies are really designed around that. Banking is about 10 years ahead of insurance, where they've started to think about reducing that friction from the customer. But in reality, insurance today is a little like this. And actually, the way HSBC designs its internet banking looks a lot like that too. Start thinking about data points, and we think about things like KYC, and it's so important. We've got to look at the number of data points that we're competing against. So our competition aren't other banks, they aren't other insurers, it's actually the tech platforms. So if you take Baidu, in insurance, we can collect, in the, I can't disclose the actual numbers, but it's in the hundreds of data points around customers. What the tech company is doing, Baidu as an example, collect 19 million data points around a customer. So how do you compete? We need to think through these issues as an industry, and we need to be able to move back up out of the death zone and into the compete zone. Unless we're starting to think with how we compete with technology companies and how we use our premiums around our experience, brand premiums, our experience premiums, etc. We do have a premium as an industry, but unless we're actually in the competitive zone, if your pricing is 40% off market, you haven't got a hope. So we really need to focus on that whole continuum from capital to risk, ops, service, distribution, and customer. And we really need to think about how we make it all intelligent from the back end to the front end. Foundations really do matter. And for me, it's a three-step process. We've got to learn first. I've been in front of many boards, many CEOs, and many excos. Unless we learn, when I first went to talk to exco and the board around artificial intelligence in banking, they said, no, that's just in healthcare. When I did the same thing in insurance, they turned around and they said to me, no, that's just in banking. The reality is technology is a horizontal, not a vertical. The vertical is just the application of technology. So we must learn and we must educate the senior leaders, who are the ones that often have the least knowledge about what's happening out there, to help them understand so they can make an informed decision. Otherwise, the only responsible answer for a senior member of staff, a senior member of leadership, or an exco, or a regulator has to be no. So how you do that is to create ecosystems of learning: corporations, universities, entrepreneurs, government, customers, and platforms. You need to work out how you interact with those and how you transfer that learning to leadership so they understand how to make better decisions. And then what the implications of that are on actually reframing the business model, not just the technology. Then the next step to that process is to venture. How do you actually start doing small things that generate ROIs? How do you build winning teams that start putting together the puzzles that actually start yielding? Then how do you pilot, test, and learn? How do you set expectations around the deployment of capital? In DBS and public numbers, my first year budget was about $250,000 in innovation. By the time I left 2 years later, it was publicly $220 million. It's kind of the same thing. How do you put your own corporation onto that growth path? Or as a startup, how do you help educate the corporation as to understanding those challenges? And then the final stage of that is when you've started to prove and you've built confidence in understanding what they've learned and applying it, then how do you open up the taps on investment? We see an inverted investment curve in most corporations. They invest very heavily in obsolete technology and sustaining technology and very little to the side. I think that what we really need to do is start rethinking architectures and rethinking ecosystems from an architecture standpoint, from a business standpoint, and from a collaboration standpoint. And really the core game today is around designing for high velocity data. If you haven't designed from the foundations are up, you're not going to be in the game, and artificial intelligence must be at the core. So I think we have a unique opportunity in financial services, and it's our game to lose. And so far, it seems to be that the financial services companies are doing a very good job at losing it to the tech companies. But I think we have the opportunity to really change the game and to transform millions of lives. So with that, I'll conclude, and thank you.
Oh, fantastic. Thanks, Steve.
No worries. When you're presenting, you're wondering if you lost connection like a minute after you started, and I've just talked for an hour.
Breathless. Now, with that big opportunity, though, which comes back to kind of the beginning of your presentation, a big opportunity with how many employees, and maybe that's more a societal question than kind of the industry question, but what do we do kind of with all the people we're setting free, basically?
Well, actually, that's a great question, and I've given a range of private talks to companies like S&P and Bloomberg and a number of banks and things about this. HR need to be involved in this process, right? Because you can't have, if you want your best people working on these things, you can train artificial intelligence to be stupid, right? So if you want your best people, but they're not going to work on these projects if the end result is they're replaced. So this is a very important point, because you've got to have a very clear policy what you're going to do with people. And with your strategy, is this a growth strategy? Is this a breakout strategy? If I've got a 40% cost advantage in the market, then surely my net result should be to drive significant growth. If I'm outperforming the market, I'm moving faster. Growth is the natural answer. If you've got growth, then you don't necessarily need to get rid of people. You're scaling the front end and the customers. So your ability now is to actually do more with less, relatively. So you're augmenting rather than replacing. And I think that that's the right approach, and that you need a really bold CEO that goes and chases that. I was lucky at DBS that's Piyush got onto that, the CEO of DBS. And when we created Digital Bank, as an example, we went from, in one of our countries, steady state 5,000 customers, first year of operation with a new digital bank, which was digital, zero ops, all that sort of thing, scaled to 600,000 customers, and then now shooting for 60 million customers. So, clearly you don't need to lay off people when you've got that level of growth. You're a cost leader and a price leader in a market, and you've got the capability to do a lot more. And in fact, that model's rolling out to other countries now. So I think that there are ways, and it was voted world's best digital bank, and they released public results recently that said that their digital customers were 42% more profitable, which means they're making greater margins. If you're making greater margin, if you decline your cost base, and Dell, we did exactly this. We caved in cost, which caved in pricing, but at superior margins. And the only thing that makes up for the revenue is to drive growth. So you've got to drive that balance. That's, any business can do the same, but that's the promise of technology when it's executed well.
Great. And to kind of ask similar question I asked of Dan earlier in terms of the kind of reinventing in place versus a bimodal approach. And so DBS, kind of the experience, the country you quoted, from like 5,000 accounts to like a multiple, maybe a smaller operation to start with, but sounded like kind of the innovation in place. And so how would you make a judgment as to kind of how to transform an organization that is legacy? And you got the insurance experience too, given that insurance is like 10 years behind banking. How to ultimately start the journey even?
I think the starting is always slow. The hardest thing is getting started, right? So there's always the momentum of the present. So you do a project that gets an ROI. I mean, we did something in the innovation team that immediately, that we were told not to do actually, that actually ended up making $80 million in the first couple of months, and then the rest was history, right? If you start getting traction, then that builds a momentum. But if you really want a breakout strategy, it's not going to occur inside, it's going to occur outside. So, Digital Bank was created in DBS as a separate group. I was involved early in Jetstar, just in a very small way, but what was interesting, 6 people. Jetstar is part of Qantas. What people don't know, it's bigger than Qantas now. It was done exactly the same way. A group of highly experienced internal people moved to the side, and given a charter and a firewall to go and reinvent the airline business. So that industry, that model transfers across industries many times. In fact, the best example, the best current example of that is Tencent. Tencent had the #1 chat application, which is called Weibo in market. They created a separate group with a charter, basically, to destroy Weibo. And that created WeChat. And WeChat's what's driven their business since. So, this is a model that's proven across tech industries, airline industries, banking, and hopefully soon insurance. I think that there's a learning curve. You can't jump to it, unfortunately, because unless the senior leadership actually understand what's happening with these dynamics and get comfortable with that model, they're not prepared to invest. Mm-hmm. So you kind of got to get the small wins up front and then go for the home run.
What about Dan's earlier point, when you look at the boards and people are like 5 years away from retirement, and so the argument that basically selfishly and also incentivized from executive compensation perspective, relatively short term, just to kind of see it out to the retirement, getting themselves over the finish line, so to speak, and it doesn't really matter to them what happens to the organization 10 years from now.
So look, that happens in every industry and every board, and there's a mix. There will always be people that agitate for change, and they're your champions, and you have to find them, and you have to arm them with information, and you have to be good at persuading to get people. I've had conversations directly with CEOs that said exactly that. I'm a couple of years from retirement. I get it. I see it's going to happen. That my business is growing now, it's doing well, and this, anything we do on the side is a distraction, right? So, and I get that. But, an enlightened board, someone, boards perhaps more than the executive team are charged mm-hmm. with the long-term sustainability of the company, right? And then they're also responsible as directors. So, getting, what I found where it works really well is if you've got a really supported board, and a visionary CEO. If you don't have that, and I've worked for CEOs that aren't as visionary, where they're cost cutters, if you've got a cost cutter CEO, then my personal experience is you're largely wasting time.
Yeah. Maybe completely sort of slightly different question. So if I were my younger self and I'm back to 18 years old, what would I pick up in university these days to ensure kind of a promising and profitable career?
I've encouraged my own kids. I know it sounds like I'm a heretic, but not to go to university, because I don't think that the university curriculums can keep up. I prefer them to go to something like Singularity University, or to get them reading a lot to keep track of all the developments, because I think what's really important is breadth of understanding more than a particular vertical expertise. If you're an actuary, which is the most valuable insurer today, for me, AI is just replacing actuaries with algorithms. And they're doing it a much better job. So that's not really a valid career. You need to have, for my own kids, I encourage them to try and get skills that are much more broad, that enable them to see across different disciplines to work out where new opportunities are. Because I just don't think what I'm seeing, particularly in the US, and I'm Australian, but same thing's happening there. If people are loading up with massive debt that they may never repay in their lifetime to get a degree that's fundamentally useless at the end of the period. So, I think things are on the tech front are moving so quickly that a new approach is necessary. And self-motivated learning is often much better than structured learning at a university, because you're a recipient, not an initiator. And in this world, initiative is everything. That's just my personal view. So I'll apologize for anyone committed to the institutions.
We had a raised hand here, Chico, if you want to ask your question live.
Oh, okay. Okay.
We can hear you.
Right. Yeah, I mean, the question was about essentially these insurtechs are using or starting to use alternative data to address adverse selection risks, to extend essentially insurance models to different client segments that they couldn't in the past. So what's stopping, for instance, Allianz or AIG or other insurance companies to do the same? Is it essentially one hypothesis that I have is that maybe their clients trust them less with that alternative data? Because I think if I'm a private client and I want to get insurance, a service that I didn't get from a traditional insurer, then I'm more comfortable to maybe part with data that they want, maybe from social media or other sources. But I don't personally wouldn't feel as comfortable with my current insurer having that data. Is that maybe a reason why they're not in that space, using alternative data to extend insurance services to latent client segments?
No, so I've got a very strong view about this, coming from where I've come and having written underwriting modules that are outperforming the existing by a massive margin. Even using the first element to that is they're not even using intelligence on their existing data sets that would lead them to better results in underwriting, even on what they collect. So I think that, and a lot of the data that they collect is noise, not signal. So that's kind of the first thing. A lot of startups, and we saw this in banking, that said all these new data sets were better indicators. It turned out that a lot of that was rubbish because they didn't have a core baseline of risk by which they could assess that. So that assessment, you know, it's like Lemonade today is an example. I know there's a lot of hype about Lemonade, and an innovative company, and I'm a fan. But you know, they can make a decision in, 3 minutes to pay a claim. Well, I can make it in 0, and I've almost got as much chance of having the same loss rates, you know, as an individual, right? So the question is, are there 19 algorithms actually using data that actually is proving a better risk line, or are they just adding more noise in terms of data? So for me, it's very important to baseline your existing risk data and juice that to the max before you introduce new data sets where you're just kind of guessing. So that, for me, I think the existing insurance companies have this huge asset that they're just not using properly today. And the second part of that, you know, and if you look at it, what drives growth in customers? If I remove friction, you know, so what Lemonade does removes a lot of friction for customers. But the quality and the sustainability of their business, if their risk management results are so bad, may not indicate or give customers faith that, you know, for a long-term product like insurance, that's a viable alternative for them. The better example for me is Zhong'an. Zhong'an are doing new categories of insurance, and they're learning about risk from the ground up. They're paying a huge price on the risk side, but the massive data that they're accruing means that over time, those risk models, and the same for Lemonade, over time, their risk models will probably get better than the insurers, at which point they'll have so much data that the insurers can't compete if they're just collecting traditional data. So, you know, there's kind of a mix in that strategy, but I still think from a risk management standpoint, the existing risk management is good. It's just slow, and it's not as effective as it could be because you're relying on people, linear algorithms, and you're not understanding the basically sum of risk through machine learning.
Great. Thank you very much, Steve. I think we have exhausted your hour very proactively. It's great talk. And we're taking 1 hour break and then continue with the afternoon.
Okay. Can I quickly plug, because I've ordered Gen.Life for the whole thing? I'll just tell you what we actually do for all right. So we're using machine intelligence to automate insurance. We're doing it initially as an R&D partner with insurers, and then we're building a SaaS platform and potentially doing JVs with insurers that actually do multiple things. From, you know, we've already proven on underwriting we can outperform the insurers and reinsurers, and we're extending that into an entire intelligent platform and brain, with a view of lowering costs, increasing access, and better risk, and then structuring it around growth, and shifting the industry from remediation or protection to prevention. So that's it in a nutshell. So I won't bore you, and please enjoy lunch.
Great. Thanks again. Thanks everyone for joining, and then we'll see you again in an hour. Thank you.
Okay. Cheers. Thanks. Bye-bye.